Hello and welcome to our webcast. I'm Amy Pendergrass with Moss Adams and I'm going to get us started for today's session, 2021 Post-Election Tax Outlook. Before we begin, I'm going to play a brief video.
Welcome and thanks for joining us. We're pleased to present another in our ongoing series of continuing professional education webcasts to help companies and individuals conquer challenges as they plan for what's next. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget to the right of the slide view. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions, which we'll ask throughout today's presentation. To respond to a poll, click the button next to your answer. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget to open a PDF file that you can save to your computer. Don't worry if you can't download your PDF certificate today. We'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. The attendance sheet is available in the slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit can be awarded only to participants registered as themselves and isn't available to participants who view the on-demand version. As a reminder, the presentation you're about to see isn't legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
And now I would like to turn over to one of today's presenters, Kunaal Patel, partner at Moss Adams.
Thank you, Amy. Good morning, everyone. By way of introduction, I'm Kunaal Patel, the Tax Industry Group Leader, and joining me today is John Monahan, partner from our Denver office, Desiree Clausen from San Diego, and Brian Wong from our San Francisco office. In light of the events that have taken place over the past 24 hours, I'd like to welcome you all in joining the Technology and Life Sciences 2021 Post-Election Tax Outlook. We witnessed some unfortunate scenes yesterday, but our Congress was resilient and moved forward with certifying President-elect Joe Biden. We have some clarity that the Democrats will have control of both the House and the Senate, and that could have an impact on what we might expect from tax law changes. We will be touching on some of those potential changes over the hour. On the agenda for today, we will touch on some industry trends. John Monahan will take us through a post-election tax update. Desiree will provide some federal, state, and international tax reminders. Brian Wong will highlight some of the issues to be mindful of as you go through year-end closes and tax provision calculations. If we have time, we will leave some time for Q&A, so please, if you do have questions, drop them into the chat. If we don't get to your questions, one of us will reach out to you after the presentation. Technology and Life Sciences industry trends. And with that, Amy, would you like to guide us through our first polling question?
Sure. So before we get started, we're going to do our first question, and that is, what industry are you aligned with? A, technology, B, life sciences, or C, other? And we will give you a few moments to respond. To participate, please click the button next to the answer you choose and hit submit. And as a reminder, if you would like to receive CPE credit for today's webcast, you will need to respond to at least 3 of the 4 polling questions. And it looks like most everyone has responded. So here are the results.
Okay, good. Looks like we have a pretty good representation of technology and life sciences companies, mainly technology. So touching on some industry trends that occurred in 2020, when I look back 2 years ago in the tech space, we saw some pretty large blockbuster IPOs. To name a few, there was Slack, Zoom, Lyft, but there were also some that didn't quite make it, such as WeWork. In 2020, we still saw some very large tech IPOs, ZoomInfo, Palantir, and Snowflake in September. Snowflake raised the most money ever for a software firm at IPO, in the tune of $3 billion at a valuation of $70 billion, which was about 6x the valuation it had when it raised money earlier in the year. Special purpose acquisition companies, also known as SPACs, have shown investors in companies that there are other ways to go public rather than the traditional IPO. Some believe SPACs allow private companies to go public on a faster timeline and provide companies more certainty around the valuation and capital raised. 2020 was a record year for SPACs with over $40 billion in SPAC gross proceeds raised. There were around 200 SPACs for the year compared to 59 in 2019. We suspect that this trend isn't ending anytime soon. So 2020-21, I suspect we'll see many more SPACs work their way through the system. Traditional reverse mergers continue to happen, but even more so with companies using the SPAC IPO vehicle that get effectuated through reverse mergers. We have seen an uptick in M&A activity, especially in the fourth quarter of 2020. There's a lot of cheap money out there, and we've also seen an uptick in financing, whether or not companies are cash strapped. I do want to point out over the next month, we'll be hosting a panel discussion with a law firm to summarize the technology and life sciences IPO and SPAC activity in 2020 and describe what that means for the market activity in 2021. So please be on the lookout for that. (2020) Biotech Ipo Boom. Through August 20th, 2020, the life science industry had over 47 IPOs, matching the total number from all of 2019. By the end of 2020, there were over 75. What is impressive with the biotech IPOs was their valuations. In the third quarter of 2020, both the number of new listings and the amount raised broke records, setting a scene for a year that will be hard to forget for that industry. In the third quarter alone, about $4.5 billion was raised, which was equal to the total in 2019. Looking into 2021, the changing political landscape with Democrats controlling the legislative and executive branches of government, there's a high probability we will have some significant law changes and tax reform. Both technology and life sciences thrive on innovation. Changes in consumer preferences and business models will outlast the pandemic in a post-COVID world. Consumers acclimated to new digital and remote models, which created an acceleration in shifts that were underway long before the pandemic. Edge AI, 5G, automated artificial intelligence technologies will continue to provide momentum for next generation talent management and technology supporting sustainability. We'll see continued expansion of remote working and video conferencing capabilities. Zoom became a household name, but I'm sure many of us have experienced a handful of other platforms. I suspect many new ventures will continue to emerge in the remote working sector, providing enhanced visual collaboration platforms. Contactless delivery and shipping remain the new normal. In the drug industry, the pandemic caused a major shakeup. For some, it made it quicker and easier to trial drugs. Both Pfizer and Moderna developed mRNA vaccines, the first in human history. We will continue to see more innovations through 2021 in both COVID test kits and new vaccine candidates. For other life science companies, researchers have put many traditional clinical trials on hold. We have seen a shift to virtual structure by performing consultations online and collecting data remotely. We suspect remote clinical trials and other changes may permanently alter the pharmaceutical development. Deal activity. As we worked our way out of the pandemic and having political certainty, we are optimistic that 2021 is poised for a rebound in deal activity. And though challenges remain, I'm optimistic we'll have a global recovery that is sustainable, and as the year progresses, we will see more of the normal post-recession access to capital. And with that, John, I'll hand it over to you.
Thank you, Kunaal. And good morning, everyone. Thank you for attending. I would like to first, before I jump into the Biden tax plan proposals, first talk about the new COVID-19 relief bill that came out, because there were a couple items that are applicable to businesses. And the first one being the PPP funded expenses, the qualifying expenses that enabled the forgiveness of a PPP loan. So at first, the intent was to have these be deductible, but the IRS had come out and said that they didn't believe that was right, because you were given a forgiveness of the loan, that you would not be able to get a deduction on the qualifying expenses. But as part of this relief bill, they have come out and put forward that, yes, indeed, these will be deductible for businesses, these expenses. So that's great news, and that gets rid of a lot of the problems that were going to exist with timing. Now, one thing you do have to look into and be cognizant of is the state tax treatment could be different, and a lot of states are not in conformity with the federal rules, so make sure that you check into that. The other item is, in order to provide relief for restaurants, they made what formerly was a 50% deduction for meals, 100% if it's provided by a restaurant, and that can be delivery or takeout. This does have a sunset on it. It is temporary, so it'll be applicable for 2021 and 2022. Now, with that, I'd like to jump into the President-elect Biden tax proposed policies as part of his campaign, compare that to the existing law. One of the major items is the corporate tax rate, which is currently 21%, but under the Biden plan would go up to 28%. And not only that, what Biden proposes to do is to have a type of alternative minimum tax, and that would be measured on, well, first of all, it would be corporations with more than 100 million in annual book income, and it would be a 15% minimum tax on those book profits. Now, what you would get is you'd be able to have foreign tax credits apply and be able to use loss carry forwards. That's on the corporate landscape, but in the flow-through landscape, where currently we have this favorable qualified business income deduction for flow-throughs, which is 20% of qualified business income. It's a great benefit right now. It is limited in certain instances, for example, specified service companies, but many companies are taking advantage of this. And what the Biden plan proposes to do is to phase out this deduction for taxpayers earning more than $400,000. Another item, and as I go back to this, a lot of these items were put in place with the Tax Cuts and Jobs Act, or the TCJA, and so Biden's plan in particular looks to kind of moderate these provisions that were enacted just 3 years ago. And the third one I have on this slide is the accelerated bonus depreciation. Another great benefit, provides immediate expensing, 100% expensing for most tangible property, and that includes, through the CARES Act, qualified improvement property. The Biden plan hasn't made any specific announcement on this provision, but like I said, his general viewpoint on this is to look to moderate the TCJA. So that in particular has consequences with the choice of entity and decisions around whether to be a corporation or a flow-through entity. As you can see from the previous slide, there are items that basically are detrimental to both types of entities. So whether that be the tax rate itself or the individual tax rates, which we'll mention on a subsequent slide, that also are proposed to get moderated. And also the capital gain rate at the individual level, which we'll talk about on the following slide. In the international arena, what currently has happened through the TCJA is there's two provisions in the current law. One is the global intangible taxable income, which basically is supposed to incentivize businesses to keep jobs in the U.S. and not send them overseas. So what that does is provide a tax on global tangible low tax income, and that's anything in excess of a 10% rate on tangible property. So that would be taxed currently in the U.S. The other item as part of the current law is what's called FDII, or Foreign Derived Intangible Income, and that provides a benefit for U.S. businesses that are making things in the U.S. and selling them overseas. So those are the two items there. Joe Biden's plan looks to keep the GILTI in place, but raise the rate from 10.5% to 21%. A couple other items that I'll mention there is Joe Biden's plan would also look to eliminate what was allowed as income in foreign jurisdictions, and that's the 10% on tangible property. And what formerly was allowed was that you could take your different foreign corporations, your foreign subsidiaries, and you can net the income with the losses, which would moderate the amount that's taxable in the U.S. What Joe Biden's plan proposes to do is to eliminate that aggregation and look at each foreign subsidiary on its own. So no longer that ability to net losses with income. Under the current plan in the international arena, we're kind of in a pseudo-territorial system where, irregardless of GILTI, if GILTI doesn't apply, you are allowed to defer income in an international jurisdiction or not actually be taxed in an international jurisdiction. That's a territorial system that was changed. What the Biden plan would look to do is look at specifically if companies have transferred jobs from the U.S. to the foreign jurisdictions, and there would be some clawback and penalty provisions regarding that. On the individual level, and we are concerned about individuals because we have a lot of businesses that are flow through, and ultimately it's the individual that pays the tax. So in the current law, there's a top rate of 37%, which is enacted with the TCJA. The Joe Biden plan looks to change just the top rate. We'll leave the other rates alone, but for individuals having income over $400,000, that top rate would go from 37% to 39.6%. Another very important item is currently there's a preferential rate for capital gains as well as for qualified dividends. And under the current rate, that's in place, but the tax on a 3.8% net investment income tax for incomes over a certain level, 200,000 single, 250,000 for married. What the Biden plan looks to do is to eliminate that preferential rate, not only on capital gains, but on qualified dividends. But it is for taxpayers with income just over $1 million. So it wouldn't apply to everybody, mostly focused on high income individuals. And it would keep in place the 3.8% net investment income tax. Deductions currently there's under the TCJA, they increased the 24.8 or the exemption to 24,800,000, and it put caps or eliminated certain itemized deductions. So to put a cap on state and local taxes at 10,000, as many of you well know, and it also suspended many itemized deductions, especially the miscellaneous itemized deductions. What the Joe Biden plan would do was, what it looks to do is generally supports eliminating that cap on state and local tax deductions, but for high income individuals, it would limit the benefit they would receive on itemized deductions to a 28% rate. So even if you were in a higher tax bracket, what you would get is a cap on your benefit is 28%. And then it would look to reestablish what formerly was known as the peace limitation, which would phase out your itemized deductions over certain income levels. For estate taxes, currently there's very favorable law in place, and that has a estate and gift tax exemption at a very high level. It's $11.58 million, and it was formerly $5 million, but that was changed to TCJA. And also, another very favorable item regarding estate taxes is when you will property to somebody, that gets a step up in basis to the fair market value. And that in particular is what Joe Biden's plan looks to eliminate. And it also looks to reduce the exemption amount as well. Other tax provision items that are important here: payroll taxes, very important. Right, currently, employer and employee split Social Security taxes, and that's paid in combination at 12.4% up to a certain income level. And that currently for 2020 is $137,700. But after it reaches that level, there's no obligation for Social Security tax. Joe Biden looks to change that. And what he's proposed to do is once the income level or the payroll earnings reach $137,700 or whatever that will be, because it's adjusted for inflation, looks to cap it there. But once you reach $400,000, then it comes back into place. So there's really kind of a donut hole there where there's no taxability, but once it reaches a certain income level, it kicks back in. So need to be aware of that from both an employer and an employee perspective. Retirement incentives. Currently, we have the 401k plan contributions that are non-taxable, and any appreciation on those 401k accounts are non-taxable until you withdraw that. And there's also a catch-up provision that's allowed for people that are 50 or older. So that's in place now, and what Biden looks to not change that too much, keep that in place, but in some instances enhance it. And really what he wants to do and look at in particular is, the current 401k plans are done by certain companies. He wants to make it more broadly based and enable smaller businesses to participate in it, and in effect help them get set up with those and make it less costly. He also looks to have, just like the 50-year-olds had an acceleration or could add on to the contributions, he wants to do that for caregivers of elderly individuals. And then he looks to have, in some cases, there's a deduction for, let's say, IRA deductions. He looks to have a credit instead. So all these are what he's looking at. I can say with, as Kunaal mentioned, with the Georgia election and the way that's turned out, these are much more likely to happen because this falls in the Budget Reconciliation Act, which only requires a simple majority over 50%. If it ties at 50-50, we've got the Vice President and the Senate that decides it. Now, that's not a given because there could be some defections on the Democratic side, but it makes it much more likely. So with that, we have a polling question.
All right, thank you, John. So our second polling question is, how many employees does your company have? A, 0 to 50, B, 50 to 100, C, 100 to 200, or D, 200 plus? And for those of you that would like a copy of today's slides, you can download them from the folder that says slide deck and handouts. We will also be sending the slides via email tomorrow, along with a recording of the webcast. We'll leave this up for about 10 more seconds to make sure everyone can get their CPE. Okay, here are the results.
Okay, large companies that we have listening today. So that's a lot of the Biden tax plans are, like I said, geared towards the larger corporations or the larger or high-income individuals. So definitely be cognizant of that. So with that, I'm going to turn this over to Desiree to talk about the federal and state tax update.
Hello, thank you. Hi, I'm Desiree Clausen, and I'm a Senior Tax Manager here at Moss Adams, and I'm going to be providing a high-level federal and state tax update as it applies to various business tax legislation enacted over the past year or so. And so I'm going to start off with CARES and then also touch a bit on the Consolidated Appropriations Act, which was just signed in a week or so ago. So this first slide provides a summary of the business tax provisions included in the Coronavirus Aid, Relief, and Economic Security Act, aka CARES. I'm not going to go through all of these because I think a lot of these were addressed over the last compliance cycle, but I did want to touch on some of the key provisions. The first being the NOL modifications that were provided by the CARES Act. So the Tax Cuts and Jobs Act, which was signed in back in 2017, provided an 80% limitation on the utilization of federal NOLs beginning with taxable year 2018. So CARES comes in and actually gets rid of that limitation for calendar taxable years 2018, 2019, and 2020. We were hoping that the Appropriations Act would extend this legislation. Unfortunately, it did not. So another key provision as it pertains to NOLs was that CARES provided that federal NOLs generated during calendar taxable years 2018, 2019, and 2020 could be carried back up to 5 years to offset taxable income generated in those particular years as to obtain a refund. So that was a real valuable one, and I know a lot of our clients took advantage of that one over the past compliance cycle. What was nice about that is you've got NOLs that are being generated during years that provides a 21% corporate tax rate, and you're able to actually carry those back to years where the highest tax rate was 35%. So it just really provided a very nice benefit. So another provision that was issued as part of CARES was IRC 163, as part of the Tax Cuts and Jobs Act was IRC Section 163J. So this particular provision provides that interest expense is limited in deductibility to 30% of adjusted taxable income. So CARES comes in and says, hey, we want to make this provision less detrimental. So instead, your interest deduction limitation is going to be equal to 50% of your adjusted taxable income, meaning that companies could deduct additional interest expense currently. So we were hoping, again, that the Appropriations Act would actually extend this particular provision just because it is so valuable. Unfortunately, it did not. Another thing to think about is that new regulations were issued throughout the year that provided additional IRC 163J guidance. So next, I'm going to talk a bit about the employee retention credit. So the employee retention credit was signed into legislation via the CARES Act, and it applies to qualified wages paid March 13th, 2020 to December 31st, 2020. So it's essentially a credit against Social Security taxes for each qualifying quarter equal to 50% of qualified wages, up to $10,000 for all quarters per employee. So the credit ends up being worth about $5,000 per eligible employee during 2020. Now, in order to be able to obtain this credit, you've got to meet one of two criteria. So the first is the employer must have had a partial or full suspension of operations of her trade or business during the calendar quarter due to government orders that limited commerce, travel, or group meetings due to COVID-19, or a significant decline in gross receipts from fiscal year 2019. And so the way that you look at whether a significant decline happened is it begins with the fiscal year 2020 quarter in which gross receipts are less than 50% of gross receipts for the same quarter in fiscal year 2019. There is also a limitation on the number of employees that an employer might have. So employers with more than 100 employees, unfortunately, eligible qualified wages were only for those paid to employees who aren't providing services due to the circumstances above. So if you've got more than 100 employees and they were providing services, unfortunately, those wages can't be included in your credit computations for this particular time period. Now, something that came out with the Consolidated Appropriations Act that I think is really advantageous is there's a retroactive provision that goes back to March 13th, 2020 that says taxpayers are eligible for the employee retention credit even if a PPP loan was obtained. So CARES originally provided that if you received a PPP loan, you couldn't also access this credit. The Appropriations Act gets rid of this particular provision. However, it says that wages paid for with forgiven PPP loan proceeds are not eligible for the credit. So you can't double dip in terms of those types of wages. So I would say that this particular provision really, I think, provided easier accessibility for the credit, just because prior to that, companies who had received PPP loans didn't have access to this particular credit. So now also what happens with the Consolidated Appropriations Act is it actually extended the credit and provided easier accessibility. So again, for qualified wages now paid from January 1st, 2021 to June 30th, 2021, you've got a credit against Social Security taxes for each qualifying quarter, but now it's equal to 70% of qualified wages up to $10,000 per quarter per employee. So it's now actually worth up to $14,000 during taxable year 2021 per eligible employee. So the credit's just got a greater value for this second tranche, and then also increased the employee limitation. So now if you've got employees of less than 500, your eligible qualified wages are for those paid to employees who are or aren't providing services. So I think this really also expanded the accessibility of the credit. So another item that I wanted to touch on is with respect to research and experimental expenditures. So this actually comes from the Tax Cuts and Jobs Act that was written into legislation back in 2017. So what it says is that R&E expenditures generated during taxable years, really beginning with 2022, have to be capitalized and amortized. If they're domestically performed, you've got to amortize them over 5 years. If they're foreign performed, you've got to amortize them over 15 years. And I know there's been a lot of lobbying against this particular provision, and so we were hoping that the Consolidated Appropriations Act would get rid of it. Unfortunately, it did not. So just something to think about as we move into the next couple of years. I also wanted to touch on California AB 85. So that was just legislation that was passed by Governor Newsom earlier in the year. And I think there's really two impactful provisions contained in this particular piece of legislation. So first, it disallows the deduction of California NOLs during taxable years 2020, 2021, and 2022 if a taxpayer has federal AGI or taxable income greater than $1 million. So it's kind of interesting. It's actually based on federal taxable income numbers. And if your NOLs are actually disallowed, the carry forward period is extended just in varying degrees. Another key provision contained in this bill is the limitation on the amount of income tax that can be offset by business credits up to $5 million for taxable years 2020, 2021, and 2022. So that means you can't use your business credits to offset taxable income by more than $5 million. And I think two credits that this is particularly applicable with are the R&D and California Competes credit. The carry forward period, if applicable, is extended by the number of years that a credit is disallowed by reason of this limitation. With the R&D credit, that isn't particularly applicable because it's got an indefinite lived carry forward period anyways. So it looks like we've got a polling question, Amy.
All right, thank you. So our third polling question is, what % of your workforce do you believe will be back in the office during 2021? And the different percentages are listed below, A, B, C, and D. Make sure you select the answer you choose and hit submit. And once you have completed all CPE requirements, you will be able to download a PDF of your certificate from the CPE progress window. And we will leave this up until enough of you have responded. Okay, here are the results.
Thank you, Amy. So now just a couple of housekeeping items. One that I wanted to mention is with respect to telecommuting. So during coronavirus, we've got a lot of people working remotely, and some people have opted to work in states that are not their typical place of residence. So just something to think about when you're going through and determining where you've got nexus from an income and sales tax perspective, and also about thinking about this when you're thinking about your relevant withholding requirements. What's nice is some states have issued COVID-19 specific guidance. And then one last slide. A slew of final regulations were issued over the past year pertaining to international tax reform. So just something to think about as you're going through preparing your income tax returns in this upcoming cycle. So final regulations were issued with respect to FDII, GILTI, BEAT, and again, just considering to think about entity choice. And now I'm going to hand it over to Brian so we can provide an ASC 740 update.
Awesome. Thank you, Desiree. Good morning, everyone. Again, this is Brian Wong, and I am a Senior Tax Manager based out of our San Francisco office. I'll be going over the ASC 740 tax considerations of the items we discussed. Before I do, I believe we have a polling question. Amy, would you like to go over this one?
Sure. So we're going to get our last polling question out of the way here. It is, did you apply for the PPP loan? A, yes, B, no, or C, I don't know, or NA. And you do need to respond to at least 3 of the 4 polling questions to get CPE credit. All right, there are the results.
All right. So it looks like many here did not ultimately go through with the PPP loan. I think that's in line with our expectations and what we're actually seeing in our market. There was a lot of interest when the PPP loan was announced, but ultimately a lot of companies decided not to go through with it. All right, so as some of us are preparing for calendar year-end financial statements, here are a few things to take into consideration for the 2020 calendar year-end tax provisions. As previously mentioned, for federal income tax purposes, net operating losses generated between calendar tax year-ends 2018 through 2020 can be carried back up to 5 years. For 2020, that means NOLs may be potentially carried back to 2015 through 2017, and as most of you know, the maximum federal tax rate pre-December 31st, 2017 was 35%. So if you have a federal NOL that can be carried back to a tax year with a 35% tax rate, it will be important that the company value these tax attributes at the previous federal tax rate when computing its deferred tax assets. If a carryback is available, it is also important to consider the impact on the company's valuation allowance, if there is one. Again, for the 163J interest limitation calculation, make sure you apply the 50% to adjusted taxable income rather than 30% provided in TCJA. For 2020, the charitable contribution deduction limitation was increased from 10% to 25% of taxable income. And again, it was clarified that expenses funded from the loan forgiven through the PPP program are fully deductible for tax purposes, as mentioned earlier. As changes in tax laws should be disclosed in the company's financial statements, it will be important for companies to disclose the impact of the CARES Act provisions to the company on its financial statements, similar to tax reform. Here's an example disclosure when the CARES Act provisions do not result in material impact to the company. Example, on March 27, 2020, the Coronavirus Aid, Relief, and Economic Security Act was enacted. The CARES Act changed the net loss carried forward and carried back provisions and the business interest expense limitation. The company has evaluated the impact of the CARES Act and determined that none of the changes will result in a material cash benefit to the company. Also, another clarification in 163J that should be considered is the removal from the definition of interest for purposes of computing the interest deduction limitation, commitment fees, debt issuance costs, and guarantee payments. With all of that said, it's important to look at state conformity for each state. We're all aware of Fed-state differences like bonus depreciation. It's important to keep in mind Fed-state differences for conforming to TCJA and the CARES Act as well. Next, it's important to keep in mind that the FASB issued Accounting Standards Update 2019-12, simplifying the accounting for income taxes by removing certain exceptions to the general principles in ASU 740. For public companies, this will be effective for fiscal years and the interim periods within, beginning after December 15th, 2020. If you are a public calendar year-end company and haven't already adopted, this would make Q1 of 2021 the first period of adoption. For all other entities, ASU 2019-12 will be effective for fiscal years beginning after December 15th, 2021. So that means for calendar year-end companies, that's December 31st, 2022. And for quarters in fiscal years beginning after December 15th, 2022, so for calendar year-end companies, that's quarters within December 31st, 2023. Early adoption is permitted. Note that an entity that elects to early adopt the amendments in an interim period to reflect any adjustments as of the beginning of the annual period that includes that interim period. Additionally, an entity that elects early adoption must adopt all of the amendments in the same period. Here's a list of the amendments. The first few are pretty common ones that we see. The first item here is the exception to the incremental approach for inter-period tax allocation when there is a loss from continuing operations and income or a gain from other items, for example, other comprehensive income. Under the historical guidance, an entity would have recorded an income tax provision for unrealized gains on securities recorded in OCI with an offsetting income tax benefit recorded in continuing operations. Under the new guidance, an entity would record no income tax provision in the interim period. The second item here is removal of year-to-date loss limitation in interim period tax accounting. This would occur when an entity incurs a loss on a year-to-date basis that exceeds the anticipated loss for the full year. In these situations, the previous guidance provided that the income tax benefit was limited to the income tax benefit that would exist if the estimated annual tax benefit for the full year was based on the year-to-date loss. This was removed in the new guidance, which would now potentially allow for a greater tax benefit in a quarter that has a larger loss than its anticipated loss for the full year. The third item here is the hybrid tax regimes, which relate to jurisdictions that have a franchise or similar tax that is partially based on income and partially non-income tax based. Previously, if income tax exceeded franchise tax, only the excess was income tax for ASC 740 purposes. Now it is clarified that the income tax portion should be treated as income tax, and only any excess is non-income tax based. Next is allowing the recognition of tax basis step-up for tax goodwill in a transaction that is not a business combination. We see this occur in payments to taxing authorities. Under the existing guidance, an entity is not allowed to record a deferred tax asset for the step-up in goodwill tax basis, unless it recorded a deferred tax asset when the business combination occurred. Now, ASU 2019-12 requires an entity to determine first whether the tax basis step-up transaction relates to 1, a previous business combination for which the book goodwill was originally recognized, or a separate transaction. To the extent that a goodwill step-up transaction is considered a separate transaction unrelated to the original business combination, an entity should record a deferred tax asset for this additional tax basis in goodwill. Next, there was clarification to recognize the effect of enacted changes in tax laws or rates in the annual effective tax rate computation in the first interim period that includes the enactment date. Previously, the interim guidance required companies to recognize the effect of a change in tax law and the estimated annual effective tax rate at the later of the enactment date or the effective date. This caused inconsistencies that required recognizing the tax law change impact on deferred tax assets, so the balance sheet, on the enactment date. Next, there is now a policy election that makes it not required for an entity to allocate the consolidated amount of current and deferred tax expense to a legal entity that is not subject to tax in its separate financial statements. A company may elect to allocate current and deferred tax expense from its consolidated parent entity in its standalone financial statements, as long as the legal entity is not subject to tax and is disregarded by the taxing authority. This must be disclosed in the financial statements. Next, we have ownership changes in investments from subsidiary to equity method investment. The guidance previously restricted recognition of a DTL on the portion of the outside basis difference that existed before the subsidiary became an equity method investment. Under the new guidance, an entity will need to recognize a DTL related to the outside basis difference of an equity method investment when the subsidiary becomes an equity method investment, assuming it is no longer eligible to assert indefinite reinvestment. Regarding changes from an equity method investment to subsidiary, prior guidance stated that the DTL previously recognized for foreign investment could not be derecognized when the investment became a subsidiary unless dividends received from the subsidiary exceeded earnings from the subsidiary after the date it became a subsidiary. Now an entity can derecognize a DTL and may need to if it asserts indefinite reinvestment of earnings of the subsidiary at the time of the ownership change. Again, as mentioned earlier, it's important that when the company adopts ASU 2019-12, it takes into consideration the impact of all of the changes. All right, with that, I'll hand it back over now to the team for Q&A.
Thanks, Brian. So we have seen some Q&A questions, and we do have some time here, so maybe we'll try to tackle some of those. John, maybe I'll direct this one towards you. What's your view on how the proposed Biden tax changes affect future M&A deals?
Well, I think because we've got proposed rate changes, there's definitely things to consider here, and so in an M&A deal, right, you're considering an asset sale or a stock sale, and there's changes to propose to both sides, right? Because there's a corporate rate proposed change, if there's an asset sale, that'll generate a gain within the company, and that will be taxed at a higher rate. Another item to consider for the stock sale, right, where the Biden proposals have something in there to eliminate the preferential 20% rate on capital gains. So that now capital gain can be taxed at as high a marginal rate as 39%. So that's another thing to consider. Timing will be very important here. Usually, well, not usually, but I mean, when will these come into effect? When will these proposed changes come into effect? Will it be retroactive to the beginning of 2021, or will it be, a proactive type change that won't apply until the following year or even further out? We don't know, but I would say, timing very important, and that goes in a general sense too, right? Deductions are going to be much more valuable at the higher rate periods, and then income, if you can somehow, through an accounting method change or otherwise, if you can have those accelerated into a lower income tax year, then that's beneficial as well. So all of those are considerations, and what I'll say ultimately is it's going to take some modeling to understand what scenario is the best for you. But both sides of that equation in the M&A world have, any types of M&A, have repercussions and things you need to think about.
Thanks, John. Brian, we have some questions related to financial statements. We know a lot of companies are in the year-end close process right now. Tax tends to be an area of higher risk, material weakness or control deficiencies. Brian, so the question is, what do you see as some of the higher control risk areas with the tax provision calculation?
Thanks, Kunaal. That's a good question. As it relates to what we're discussing right now, the potential of rolling forward prior year's model and not updating for the new tax law changes is one to take into consideration. This could impact the company's internal controls if not done correctly over both whether the tax provision is reviewed thoroughly, which is typically a key control, and whether the company has controls to identify new tax law changes, which is sometimes what we see as also another key control. So those are definitely things to take into consideration from a control perspective. From a materiality perspective, the changes we discussed today can be material based on the company's fact pattern. The one that in particular we want to just point out again is the federal NOL carryback. Both from valuing the NOL carryback at a different rate, if an NOL carryback is available, is important because of the rate differential between 35% and 21%. And then also whether a VA needs to be released if there is one, because the NOL can actually be recognized.
Thanks, Brian. There are quite a few questions running through the chat related to tax planning items. So maybe John, Desiree, you could share some thoughts based on your client base. What are some of the major tax planning opportunities you're seeing?
Well, I have one. Sorry, go ahead, Desiree.
Okay. Yeah, no, I mean, to me, I think the biggest thing is just taking advantage of all the incentives available under CARES and also really with the Appropriations Act. A big one that's just been coming through a lot is now the employee retention credit. I think it's really been expanded in terms of who it's available to. So especially, now that if you've received a PPP loan, you can still take the credit. So that's huge. I mean, that booted out tons of our clients last year. And then also the 500 employee limitation, that's also huge because, prior, if you had employees over 100, you couldn't take, there was just limited amount of wages that you could use to actually take the credit because you could only apply wages that were paid to people who weren't actually providing services. So now, if you've got less than 500 employees, you can include wages that were paid to employees that were or were not providing services. So that's just something that I think a lot of our clients are looking at. Also, with respect to the R&D tax credit, like I mentioned in 2022, you've got to start capitalizing your R&D expenses and amortizing them. So that kind of limits the amount of expenses that go into the R&D tax credit. So just planning for that and sort of thinking about it, I think can go a long way. So, John?
Right, and I was just going to say, basically what could happen in the future, and you want to be cognizant of, there's some very beneficial expensing items right now, such as, bonus depreciation, in particular, qualified improvement property, and the FDII deduction, which pertains to companies selling U.S. products and services overseas to foreign jurisdictions and earning income that way. You want to think in terms of, if we're expecting a higher rate, we're going to get more bang for our buck, basically, if we can defer some of those expenses into that tax period with a higher rate. So I think that's one item to think of. And just in general, accounting methods, whether to accelerate or defer income, whatever way you want to do it to get your best result via the tax rate involved would be something to really focus on.
Great, thank you. So we are closing into the top of the hour here. I did want to thank everyone who was able to join the broadcast. Appreciate your attendance. We should be making the slides available as well as a recording. And with that, Amy, I'll hand it over to you to close out the session.
All right, thank you, Kunaal and John, Desiree, and Brian for a great presentation today. If we didn't answer your submitted questions, we will do our best to follow up with you after the webcast. And as a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in the slide deck and handouts window. If you participated as an individual and met all certification requirements, your certificate is available to download now in the CPE progress window. I'll keep the webcast console open for a few minutes to give you time to download. A copy will be emailed within 3 weeks should you have any difficulty downloading it now. And here is a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete the survey as your feedback is very important to us. Thank you for joining our webcast. We hope you'll join us again next time.